Index funds, ETFs, everyone's talking about them, but nobody's telling you the one thing that actually determines which makes you more money. It's not the fees. It's not the fund manager. It's not even the market. And if you pick the wrong one for your situation right now, you could be leaving thousands of dollars on the table over the next decade without even knowing it. I'm going to show you exactly what the difference is, which one wins in 2026, and what you should do with your money today. Let's get into it. Quick disclaimer before we dive in. This video is for educational and entertainment purposes only and is not financial advice. Always do your own research or consult a licensed financial advisor before making any investment decisions. First, let's make sure we're on the same page about what these actually are. An index fund is a type of investment fund that tracks a specific market index, like the S&P 500, which is the 500 largest companies in America. Instead of a fund manager trying to pick winning stocks, the index fund just copies the index. It holds the same stocks in the same proportions. Think of it like this. Instead of trying to pick the best individual fruit at the market, you just buy a basket that contains everything. You get the whole market's performance. No guessing required. Now here's where people get confused. An ETF, which stands for Exchange-Traded Fund, is not a different type of investment strategy. It's a different structure for holding investments. An ETF is simply a fund that trades on a stock exchange, like a regular stock. You can buy and sell it throughout the trading day, just like you'd buy a share of Apple or Tesla. So here's the key insight. Most ETFs are index funds, and many index funds come in ETF form. They're not opposites. They overlap significantly. The real comparison isn't index funds versus ETFs. It's ETFs versus traditional mutual funds. Let me explain. A traditional mutual fund, including most index funds sold by companies like Fidelity and Vanguard, is priced once per day after the market closes. You put in your order and you get whatever the price is at the end of the day. An ETF, on the other hand, trades in real time throughout the day. The price fluctuates every second the market is open, just like a stock. For most beginners, this difference is almost irrelevant. If you're investing for the long term, which you should be, it doesn't matter whether you buy at 10 in the morning or at end of day. The 30-year return is what counts. The main practical differences come down to three things. Minimum investment. Traditional mutual funds sometimes require a minimum of $1,000 or even $3,000 to get started. ETFs can be bought for the price of a single share, sometimes as little as $1 with fractional shares. Tax efficiency. ETFs have a slight structural advantage here, which results in fewer taxable events throughout the year. This matters more in a regular taxable brokerage account than in a Roth IRA. And automation. Traditional mutual funds make it easier to set up automatic monthly investments of a fixed dollar amount. With ETFs, you typically need to manually buy shares each time. Now let's talk money, because this is where it actually matters. Both ETFs and index mutual funds can be extremely cheap to own. The cost you pay is called the expense ratio. It's an annual percentage of your investment that goes to the fund company. The cheapest options are almost indistinguishable. Fidelity's FZROX, a traditional index mutual fund, has a 0% expense ratio, completely free. Vanguard's VOO, an ETF tracking the S&P 500, charges just 0.03% per year. On $10,000, that's $3 annually. Where costs can differ is with actively managed funds. Funds where a human manager is trying to beat the market. These charge anywhere from 0.5% to over 1% per year. That might sound small, but over 30 years, that difference can cost you tens of thousands of dollars in lost compounding. The golden rule: always choose low-cost index funds or ETFs. Avoid active management unless you have a very specific reason. All right, the question you actually came here for. Which one makes you more money? The honest answer: if they track the same index, they will perform almost identically over time. VOO, an ETF, and FXAIX, a traditional mutual fund. Both track the S&P 500. Over the last 10 years, their returns have been nearly identical, within a fraction of a percent of each other. The difference in returns comes down to three things: expense ratio, which we covered; tax efficiency, ETFs have a slight edge here; and your own behavior, which is actually the biggest factor of all. Here's what the research consistently shows. The average investor underperforms the market not because of fees, but because of their own decisions. They panic sell during downturns. They chase hot stocks. They try to time the market. The fund structure, ETF or mutual fund, matters far less than whether you stay invested through market volatility. A mutual fund you hold for 30 years will massively outperform an ETF you panic sell in a downturn. So the real answer to which makes more money? The one you'll actually stick with. So which one should you actually pick? Here's a simple framework. Choose a traditional index mutual fund if you want to automate your investing completely, set up a monthly auto transfer and forget about it. You're investing at Fidelity and want zero expense ratio options like FZROX or FSKAX. Or you're just starting out and want the simplest possible experience. Choose an ETF if you want to invest across multiple brokerages. ETFs like VOO and VTI are available everywhere. You want slightly better tax efficiency, especially in a taxable brokerage account. Or you like the flexibility of buying throughout the day. For most beginners, the recommendation is this: open a Roth IRA at Fidelity. Put your money into FZROX or FSKAX. Set up automatic monthly contributions and don't touch it for 20 years. That's it. You'll outperform the vast majority of professional fund managers just by doing that. If you're at Vanguard or Schwab, VOO or VTI are excellent ETF alternatives. All outstanding choices. Don't let perfect be the enemy of good. Let's bring it all together. Index funds and ETFs are not opposites. Most ETFs are index funds. The real choice is between ETF structure and traditional mutual fund structure, and for most long-term investors, it barely matters. What matters? Low costs, broad diversification, and staying invested. Everything else is noise. Pick one. Automate it. Leave it alone. That's the WealthVault formula. If this cleared things up, subscribe to WealthVault for a new video every week. Next up, we're covering the 7 money mistakes that keep most beginners broke, and exactly how to avoid every single one of them. See you there.